Welcome back to the Switzer. It's been a week dominated by the budget, blustering, but let's bring it back to our bottom lines by turning to our own Roger Montgomery for his quick take on the budget and whether it will affect any of the companies he's watching right now, and particularly given what we're seeing in the mining area as well. Welcome, Roger.
How are you, Peter?
Mate?
I'm
good.
Let me give you my view on the budget. I was absolutely stunned by the amount of coverage this year. It was literally overwhelming. There were 36-page lift outs. There was 24/7 coverage, and quite frankly, I wonder, and I'm being a bit of a cynic here, but in 4 months' time, when we have a federal election, all the promises, all the cuts, all the forecasts, and all the projections might just be irrelevant.
I think you're absolutely right, mate, and there could well be a mini budget.
Exactly.
Because if Tony and Joe don't like what they see, they could easily do it. But, okay, was there anything in the budget that made you think that could change the intrinsic value of any company that you like or dislike?
No, this year, no. The answer to that, in short, is no. It hasn't changed our view on any sector at all. Or on any individual company. And I'll just make this point. If 10 years ago you'd bought Seek or you'd bought realestate.com.au or the REA Group as it's now known, if you bought car sales or CSL or Cochlear, then you've been through 10 budgets and you've quintupled your money or even done better than that. So I come back to the advice that we always give, which is to stick to really high quality businesses and just ignore these macroeconomic events. Just avoid companies that are benefiting from government feather bedding, because that can be pulled out from under them.
Okay, the critical word you used then was macro, but micro, and this is a nice link to the area that you really want to talk about, namely mining and mining services company. I don't know if you've had time to really delve into the budget, but there was a fair bit of kicking in the guts of miners and explorers with some of the tax changes. I've been doing the week with PwC and John Howard,
sure,
both in Brisbane and Perth, and a lot of the mining companies and explorers have actually been hit around a bit with some tax changes. So let's go into the mining area. We've also seen the stocks fall this week, and UGL caught a clobbering. So what's your take on that, Roger?
Well, I was very careful with my wording earlier in the segment, and I said it hasn't changed our view about, the budget hasn't changed our view about any particular sector. And our view on mining and mining services has been overwhelmingly negative for about a year and a half. So nothing's changed there. But what we're seeing now is companies like UGL and many of the mining services companies, deck mills, come out again with their results. And what we're finding is that it's now starting to hit home that not only are the big mining companies cutting back on capital expenditure, but they're cutting back on maintenance as well. And in fact, McKenzie from BHP has said they have been spending about $22 billion on maintenance, and they want to bring that down in the next couple of years to $18 billion, and then hopefully to $15 billion and even less. So the amount of maintenance expenditure is going to go down as well. So what this means is that Australia's mining services industry is facing its own fiscal cliff, and that means that beyond 2015, they really don't know where their income's going to come from or how much income there's going to be. And I'll reiterate the point that I made a fortnight ago, Peter, and that is this. There's going to be less work on for mining services businesses. There's a proliferation of these companies, and they will all be competing for less work. That means necessarily they have to lower their bids for the fewer jobs that are around when they tender. And so the ones that get the jobs will actually make less money out of those jobs, and those that don't get the jobs may just go out of business.
Okay, so let's now focus. I think this is a point well made, because we know that the first part of the mining boom was a double-fisted thing. Commodity prices were great, and mining companies were investing, so you had investment as well as good commodity prices. Now, we move into the next phase of the mining boom, and it's still going to be well, it's not really a boom, it's a slowing down boom, but there still could be a lot of export sales. and those export sales could be at lower commodity prices. So given the fact that you said McKenzie at BHP is going to cut the costs, could that actually bring a surprising improvement in BHP's profit, say, compared to last year, because they're bringing costs down, and provided, this is the proviso, that commodity prices don't fall terribly, BHP could be in an interesting position come next reporting season.
So there's three elements to what you're saying. The first one is a reduction in costs. The second one is the possibility, which would raise margins if they reduce their costs sufficiently.
Yep.
And the reason why they need to reduce their costs is they're concerned about the second element, which is lower commodity prices, particularly iron ore. But the third element is the reliance on this idea of increasing volumes.
Yep.
So if you're going to get lower prices, you need increasing volumes to offset that, and then you get the benefit of lower costs, which increases your margin, you make higher profits. But if you get lower commodity prices and lower volumes as well, and China is moving, and they've made no secret about this, they are moving from an infrastructure, CapEx-based growth to a consumer-led growth, and that will be less capital intensive. We might just find that as supply increases, the amount of volume required from China actually doesn't grow by very much at all, and commodity prices slump. So they need to work on these costs just to be treading water and staying in the same spot. There's very little growth there. Now, I've warned people to stay out of BHP for a while. I've said we're not interested. Our intrinsic value is significantly lower than the price, or it was significantly lower than the price. Not surprise, the price is now closer to our intrinsic value. But I wouldn't be buying BHP unless it was at a very big discount to that intrinsic value.
Well, I guess, Roger, if someone is a person who's prepared to buy BHP and wait 3 years, what would you say to them? Because there are people out there who be saying that. 3 years might be the time. 3 years might be the time that it starts to look interesting.
I think it's sufficiently uncertain to be investing in BHP now. I think there's not enough clarity about what the business will look like in 3 years' time, and I think, and I'm concerned, it could be significantly lower in price in 3 years' time than it is today.
Yeah, well, the interesting thing I noticed today is that Rowan Callagh in the Australian actually, backed me up that Japan could be the surprise, joker in the pack, because we often focus too much on China, and you do it, I do it. But when I was in Japan, I started to think about Japan. It's still the third biggest contributor to world economic growth, and with its 20% fall in the yen, that could be a bit of a surprise package, Roger, because they do demand iron ore and coal as well, don't they?
Yeah, they do, but nothing like the size of China. And you've got to remember, China's foreign exchange reserves amount to 45% of global reserves, and they are significantly more important to us than anybody else. And so you've got to remember that our biggest export is iron ore, and our biggest customer is China, and what happens there will overwhelm everything else. Any improvement from Japan will be marginal.
Okay, one last thing while we're on BHP, because there are a lot of people out there who are throwing their pillows at the television station, while you're saying this.
Oh, well.
The dollar is falling, and when the dollar falls, that improves the profits of key exporters.
Yes.
104 to 98. Is that going to have a material impact on profits of companies like BHP?
Well, last week I personally, this is not for our funds, but personally I switched some money out of Australian dollars and I bought US dollars, Singapore dollars and the British pound. And so I'm delighted with how that trade's been going. But at the moment, what we're seeing is a slowdown. The reason why the Aussie dollar is coming off is because traders believe that the Australian dollar is a commodity currency again, and the cycle, that booms part of the cycle, is over. So yes, it's true that the profitability or the attractiveness of our exports goes up when the Aussie dollar goes down, but it's going down for a reason, and the reason is that the revenue outlook for our miners is deteriorating. So yes, there's a positive influence, but I think that we're still looking at the early stages of the negative influence of a slowdown in demand for the products that they sell.
All right, Roger, thanks for joining us on the program.
It's a pleasure, Peter. Good to see you again.
Same here, mate.